Hi, this is Raghee Horner coming live to you from my trading office with another Forex on 5 episode. So today's topic is going to be what I call triage. Triage comes from the word trier, which is French for sorting. And if you consider, I'm not sure what you typically do right now in your trading, but let me give you a little insight into what I do when I analyze the market. And that is, I look at every pair that I want to potentially trade under the idea that there are a number of time frames that could be communicating different market cycles, slightly different support and resistance levels, different nuances about what's happening to any pair right now. So for example, we've got the 15-minute chart of the Euro US dollar, the fiber, and you'll notice I've got it under 4 different views. And the reason I do this is the view that I use when I'm doing the IBFX chats. This is not necessarily my trading setup view, but this is the best to explain the lessons that we go through. So what I've got here is the same time frame but with different tools. Here I've got the PRS overlay with the MACD traditional. Here I've got the PRS overlay, which is the pattern recognition, by the way, the automated chart pattern recognition, with my grab, my green, red, and blue candles in the wave. Here is just the PRS with just basic candlesticks. And then I've got one of my favorite tools here for identifying support and resistance, and that's my daily pivots. So I've got a number of ways to identify support and resistance, and if there is a significant move that I want to look at through Fibonacci, I'll go ahead and draw it on any one of these charts. So I've got the same chart under lots of different views to identify support and resistance and the market cycle. So what do I know about this 15-minute chart? It's traveling upwards, not really strongly, but it's in a markup cycle. I'd say a weak uptrend across the 15-minute chart. Now let me show you something. I'm going to contrast this view with the 240. The 240 meaning the 4-hour chart. And let's take another look at the same pair, but now a 4-hour time frame. So remember, it's the same pair, but now we're looking at a slightly different view of psychology. Time frame is psychology. A 5-minute chart represents a short-term view of psychology. A daily chart represents a longer-term view of psychology. So there are, of course, risk issues with longer-term time frames because the average pip movement of a pair over 24 hours is going to be wider, longer than, say, the average range over 5 minutes. So a 5-minute pattern with that understanding would be a smaller pattern. A 5-minute setup would probably have less risk and likely less reward. Just like a daily chart, because of the larger range, a larger pattern, a larger setup, will likely have more risk but likely more reward. Okay, that's just generally speaking because of the type of price movement you see. So take a look at the 4-hour chart. We just looked at the 15 and it was doing what? It was heading up in a kind of weak uptrend, a weak markup cycle. Take a look at the 240 of the exact same pair and you'll see that this thing is moving down at what I call a 4 to 6 o'clock market cycle. And what I'm doing to gauge this is I'm using the 3 lines of my wave, the 34-period exponential moving average on the high, the low, the close. This is moving in a marked down cycle. So which one do you take? Now a lot of you that are getting into this idea of managing or managing your trades but picking a single time frame from which to set up a trade run into this problem where this is not multiple time frame confirmation. I'm not trying to confirm the direction of the 15 with the direction of, say, the 60 or the 240. That's not it at all. In fact, I'm treating each time frame as a standalone. So how do I determine in this case, with a look at what's happening right now in the Euro US dollar, what I'd like to do? Well, I will tell you that the daily chart right now is very close to some key support levels. And what I'm going to do with this key support level is understand that if I'm bouncing off this area right now, this 3460 to 3440 area, which is what represents this low down here, and currently prices are sitting at about, what, 35.51? Is that where prices are right about now? Yeah, about 35.51. Some about 100 pips north of where prices have bottomed out. That is enough room to take a short on the 240 and ride it down. It does give us enough room, okay? Some of you might say, well, I don't like how close this Euro US dollar is to the low, and I prefer that 15-minute slight markup cycle where I could take advantage of the bounce and of the uptrend. It's really up to you, but what I will say is this. If prices continue to be rejected by the 200 period simple moving average on this chart, this 15-minute chart, I'm going to be more apt to take a short on that 240. And what I'll do is I'll follow this analysis, this video up with a couple charts and an article to accompany what we've talked about here. But what I want you to drive home here is this idea of triage, comparing each time frame within a single pair and looking at the nuances, market cycle, support, resistance of each to determine which one might be the best look at psychology and, even more importantly, which one's more appropriate for your risk tolerance.